much to originate that $100,000 loan or $75,000 loan as it does the $500,000 loan. So when you get that application, it becomes very much a challenge on whether or not that loan can be sold into the secondary market without you either charging your borrowers a larger upfront origination fee, which could take you close to a high price mortgage loan, or having to charge them a higher interest rate in order to generate the premium necessary to justify that loan being done and sold. So obviously, both of those scenarios are negative to the borrower. The third option is, of course, that you just simply put those loans into a portfolio product at your institution, where from the investor perspective of the MPF program, that's a negative for us. So the hope with the low loan balance is that we can provide a win-win-win situation so that you, the lender, are able to generate a necessary income stream so that that loan makes sense, that your borrower is able to get a lesser cost and potentially lower rate mortgage, and of course that the Federal Home Loan Bank is then able to obtain that asset as an investment, because obviously that is our main function through the MPF program. So this kind of visually outlines what I was just discussing as far as the costs and the challenges that come with a mortgage loan and the loan size in particular. In this particular scenario, we're simply saying it costs $1,000 to do a mortgage loan. Obviously, that's not a true indication of cost, but for the sake of math, and I need to keep it as simple as possible, we just used $1,000. In our example here, a $125,000 loan at the 5% interest rate would net you roughly 41 basis points above par at the 100.407, would generate about $508, $509 if we round it up, but obviously with the $1,000 cost is a negative number. So clearly in this scenario, you would not be offering this borrower a 5% rate, or if you did, you would have to charge them an additional $500 at a minimum in fees in order for you to come out at least basically even on that particular loan. Or if you are simply just sticking, to your rate sheet and so forth, you would end up losing money if you originated that loan and sold it into the MPF program in this scenario. Clearly, we look at the $500,000 loan and we see same rate, same price. The premium obviously significantly higher and creates an attractive net income once the closing costs or the processing costs are removed. So this goes through, and the bullets below really do address exactly what we were talking about on the previous slide as far as the scenarios that come into play on this low loan balance loan types. And so what the low loan balance premium pricing does is it allows us to demonstrate this scenario. Now, please take the pricing with a grain of salt. Obviously, we're not offering this type of a price on a 5% rate in this current environment. These are just examples of how the movement will work between the base price and the premium pricing. We'll look at the actual differences here in that pricing in a few minutes. But you can see in our example, now the $125,000 loan, still at the same rate, generates a significantly higher premium because of the premium pay-up that we're offering on that particular loan size. Premium generates well over the need of the $1,000 and creates an actual positive return on the loan, making it so that in this case these borrowers are an apples to apples comparison as far as market interest rates are concerned. Makes this a loan that can be sold into the secondary market and be delivered into the MPF program, which is obviously our end goal. So right below that, you see what we have offered or created to this point. So those of you that utilize our rate sheets currently and have looked at our rate sheets, you have probably noticed for quite some time various additional options available on the rate sheet for pricing. So basic, the 30, the 20, and the 15-year fixed rates, the base 15, 20, and 30-year fixed rate prices, and then all of the subsequent sub-product offerings. starting really from about $85,000 up to $250,000. Now, as you can see from these examples, we're only opening 5 of those currently. So there are quite a few of them still remaining that have not been activated to this point. And I point this out because obviously we talk about opening these up, and if you select the wrong one, you'll still be receiving an error message that you possibly have received in the past that says these are not currently available. Only these 5 specific sub-products are available. The $175,000 max on the 15, the $175,000 on the 20, and then the 125, the 175, and the 225 max on the 30. So each of those specifically offers a better price than the base 30-year rate sheet does. And it will always be a better price. We wouldn't activate it if it wasn't going to be a better price. So know that if your loan is coming in below one of these loan sizes, and we'll talk a little bit more about that structure here in a minute, that utilizing these will always be the best option if the loan is being delivered into the program. So again, as I mentioned, is this pricing really any better for you? Now, this is a true example on the 30-year, because I use the 30-year because obviously there are multiple options available. This pricing was just under a month ago. We see a 6.5% rate, 30-day term on this loan. The base price on the 30-year on that day was a 101,234. So if you sold a $100,000 loan, you'd make $1,234 with the sale of that loan. You see the $125,000 max is taking that up basically 77 basis points. So it's 3/4 point improvement in price on loan sizes below $125,000. The 175, you see the difference is about 57, 58 basis points, depending upon which way you round it. And then the 225 is taking it up about, in this case, 41 basis points. The differences, they do vary slightly. That correlation that we just did will always somewhat be there, meaning that the lower loan size will be a higher rate than the higher loan sizes, but the differences between them, the spread above or near the base price could differ slightly, but there will always be some sort of an adjustment that is being made. So you should always be able to take advantage of those on any of the loans that fall, again, below the $225,000 loan size. So why do we do this? And that's a very fair question. We haven't done it for 20 years. Why do we start doing it now? Well, there are a couple of reasons. First and foremost, as Fannie and Freddie, as I mentioned at the beginning, have started to offer this particular option, it has created a situation where loans that maybe we would have been able to obtain in the past from our members are now going somewhere else because they're able to get a better price, and as they should. It's also what it did is through the fact that Fannie and Freddie were offering such things, it created awareness on our behalf. As we started to do that analysis as to why would they do this, we did that same analysis on our end and determined the same thing they did, that these loans are actually quite an attractive investment. Those smaller loan sizes are very much less rate sensitive. So meaning that if I have a lower loan amount, it takes a bigger movement in the rate for me to see any benefit to do a refinance, right? I mean, $100,000 loan, 3/4 point or even a point movement in rate isn't going to drop my payment a great deal. $500,000 loan, it could be significant. We're living through that right in this current environment, correct? We talk about people who did their loans at 3%, now looking at 7% or higher. It significantly changes that monthly payment amount, which means that they're far more likely to look to refinance the minute the rates move if you've got a higher loan amount. So on the lower loan size, what that means is those loans stick around longer. So as an investor, stable income is the gold standard. It is what you look for. Something that will be there for a while and generate a stable income for you is key. So it became a reality that these loans are actually worth more. And straight from our CFO's mouth, Jeff Coosbell, if you've ever had a chance to meet Jeff or see Jeff at one of our meetings, he basically said, if those are worth more, we should pay more for them. That is the purpose of our role in this environment. We are cooperative. Our job is to do what we can to help you as our members and stockholders do better. One thing we can do is that on an asset that is worth more, we can pay you more for it. And so that is what we decided to do. This is a process that we agreed to move forward with towards the end of last year. We needed to get comfortable with how this pricing would be set up and where our adjustments would be made. I've been with the MPF program for 18 years. Some of you have worked with me for that long as far as members of the program. Others obviously not as long. This is the first time we've done anything like this within the program, the traditional program specifically. We've never had anything about a loan characteristic that adjusted our pricing before. So this is extremely new. It's new for us and obviously new for you as it pertains to the MPF program. So that is why we want to make sure we take this extra time to go through it with you, address any questions and concerns, and lay out some of the red flags for you so that you're much more comfortable with this process. As with everything, the more comfortable you are with anything, the more often you are going to use it, and the better your understanding will be. Well, here's the other good side of this. Okay, what do you got to do to use it? You know, what's next? What do you have to do? Everybody's all fired up and ready to use this now. I'm going to make more money on these loans. Why wouldn't I do this? What do I got to do? Nothing. You've already got access to it. The pricing is already available to you, as we just mentioned, which we'll look at here in just a second. There's no special master commitment. There's no addendums to the masters. You may remember previously when we had activated appraisal waivers, we had started with special addendums to those master commitments. None of that on this particular function. You simply just go out and access the pricing, and when you lock the loans, as we'll look at here in a minute, then that is how you'll be able to take advantage of it. So the good news is there's nothing you need to do any different than you're doing now other than add the additional step that we're going to walk through here very soon. So let's just take a look at it here. First, I'm going to pull up, share my screen with you, and pull up an application for you to be able to see. So we're looking at, and we're going to look at the current rate sheet. And just give you an idea of what that rate sheet will look like. So if we went into the pricing on our rate sheet, and while this is pulling up, let me point out, if you utilize any of the current pricing engines, and when I say a pricing engine, everybody's got different terminology, but Moretech, Optimal Blue, it used to be LE May, I think it's under a new name now, but any of those particular pricing engines, they all have this embedded in them at this point. So you don't need to do anything any different. You may want to check with them. If you have a rep, you may want to confirm with them that they've got it uploaded. They should have, but it's always best, or at least double check the pricing when you have an opportunity to on their behalf. And I won't pull up all of them just because it just creates a lot of information, but I do want to pull up at least a couple of examples, and we'll look at them connect next to one another. So this is, and I'll pull all the way down to the bottom just so we start with the base rate sheet. So here is our current 30-year base rate sheet. And we'll just look at we'll use the 6.5% rate because it's right here in the middle. we'll go to the 30-day. And so if you take the 6.5 across the 30-day, you see it's about 64 basis points as a premium. If you're comfortable with reading our rate sheet. So it's probably not the rate that you're going to use on a lot of loans. It depends upon the scenario, but that is still a positive rate at this point in time. But let's say the loan amount was $100,000, just because that's a fair number to pick. If we go up to the 30-year 125 max loan, and we pull up the 6.5, you see that rate jumps up quite a bit. It's, that 72 basis points, I think. I can't remember exactly what the other one was, but 62 basis points in there. It's around 67 plus basis points better in pricing. So you see a significant increase in that price. So it justifies, realistically, that 6.5 could work for one of those smaller loan sizes. Likewise, if that rate fell and it was between 175, or between 125 and 175, then you could simply look at the 175 max rate sheet, and you see the 6.5, still an attractive rate of about 123, as far as the premium is concerned. You'd be making on a $100,000 loan, $1,227 on that particular loan. So generating still, as we looked at in our example from February, a better premium on that particular loan. Now, as we talked about earlier, only certain ones of these are active currently. And so if you came out here and said, well, I just picked this 150 just for the fun of it, what you're going to find out is, the 125, the 170 are all there, the 30 is all there, the 150, that product is not currently available. Because again, we have not activated that particular tier. So on a loan that falls into the $150,000, you would need to go into the 175. The 150 is not currently available. And that's, again, what we'll talk a little bit more about that structure here in just a minute. But again, I just wanted you to see that as we look at the rate sheets today, that is exactly how it will work. There's nothing special that you need to do. You simply just go after the rate sheet, but you do need to select the specific rate sheet that you're looking for. So just like you would if you're picking a 20-year or a 30-year loan, you now need to also pick what the loan amount size that you're looking for. And again, it allows you then to be able to receive this much stronger premium on that particular loan. So let me now pull up the transaction site and share that with you. Grab the right one. Nope. This. Okay. Let me log back in here real fast. Get to see my typing skills. So when we look at this pricing, and this is our demo site, by the way. So when we pull this up, the pricing is going to look different. And it's just simply because this is just a test site that allows us the ability to work through this information and not actually lock something into the system, because obviously you don't want us to have that authority, and of course we don't want to have that authority on behalf of any members. So this site's just for us to go in there and not break anything, but be able to better understand how the processes work on your side of it. One of the ironies that I've always felt in this program is that we talk all the time, and Aaron does this now constantly with folks, go through the process of how to do this, but neither one of us have ever actually done it because we could never access this information. So we've always had to learn through screenshots and so forth, and now with these demo sites, it allows us the ability to be able to take loans through this process. Let me pull up the pricing real fast. We were having a little trouble with the pricing and may have gotten that corrected here this morning. So Let me just see if it is. If not, then when we go through the transaction, I can be prepared to discuss it with that in mind. Just to hit this and see what we get. Yeah, they don't have it up there. So you see in this case, obviously, because it's a demo site, and that's why I pulled up my my ability to access the rate sheets, because I did want you to see that they were live. But you see from a demo site that they're not currently available. But we can still take you through the majority of the key pieces of information in the transaction without that. So obviously, the difference in this and where it comes into play is when you do the delivery commitment. Up until that point, everything that you've done transactionally remains exactly the same. And really, the delivery commitment remains exactly the same. Just a little bit of attention needs to be paid to one specific field. So when we pull up our transactions and you go in to do a delivery commitment at your institution, or others do that delivery commitment, you simply go into the create. You would select yourself your master commitment. It doesn't matter which one it is, whatever your master commitment is. You would have a delivery amount, and we'll just say $100,000 in this example. And you would pick your product, and that's, we'll say, is the 30-year rate. And now really to this point, the way you would do at that point is you'd go to the commitment term and you'd do your note rate, and then you would get your pricing review to take a look at. Again, now with this pricing not available, I can't do this specifically, but the key now is this field, the subproduct field. The subproduct field is what is necessary to get access to or to carry over the premium pricing. If you do not select the subproduct field, it will default to the base pricing. It is not going to know, based on the loan amount, what you're attempting to do. So it is important that you would then mark this appropriate pricing sheet. Now, it'll give you this, and of course this error won't be there when you do it, the red one won't, but this alert at the bottom will be. And make sure that, you and again, other staff, if they're not on this call right now, make sure you're aware of what you're doing. So you've selected that 125 max. The amount that is being funded must be less than or equal to the 125,000. And obviously, if you have any questions, you can reach out to the service center if you're confused by what that is telling you. Another challenge with this, or not challenge, but point of emphasis, is that the system, and as that tells you, each loan funded under this delivery commitment. So don't expect that if you went in there and you set a $200,000 loan, or delivery amount, and a subproduct, and you hit the 125 max, that it's going to error you out. It won't, because it doesn't know that if you're only trying to sell one loan for 200,000 or two loans for 100,000 each. So the system does not have an edit in place, nor could it, that will keep you from locking in correctly. And that is important, and we'll talk about that when we jump back over to the presentation here in a minute, and we kind of go through some of the the pitfalls and words to the wise on this process. But it's very important, and it cannot stress enough, the key to this is the subproduct field. You've been able to ignore it for, I think it's been close to 10 years that it's been out there, but not really activated. And now it is of importance to you in order to be able to gain that pricing. Now, the good news is if you don't mark it, you'll still get the 30-year fixed price that you chose. So it's not as if the delivery commitment can't be used. You just won't get the benefit that you were, I assume, attempting to get by selecting one of the other tiers of subproduct pricing available to you. Again, the rest of it will flow through just as it always has. You'll select your appropriate commitment date. You'll select your note date, and then you will receive the pricing listed. Obviously, the first few times you do this, check that pricing. Make sure that it looks like the amount that you were expecting to see. If you thought you were going to see 134 basis points and it comes up at 68 basis points, take a look back. Did you hit the subproduct field, right? Or, did something get messed up when the pricing was put in? It's always good to verify that information so that we, just as much as you, are made aware of any issues or questions that arise. Again, as I mentioned, 18 years that I've been here, we've never done anything like this. So there's growing pains on both sides of this fence. So we want to make sure that you take that extra step and that extra beat to make sure this information is exactly set up the way that you want it. Now, as you'll notice, when we looked at those sub-products, all of them are available, but again, only the 125, the 175, and the 225 are currently active on the 30-year, and only the 175 is active on the 15 and the 20-year. So again, make sure you're marking the appropriate ones when doing this. And so this, even if you use the pricing engines, you'll still need to make sure you do this part correctly, because that doesn't carry over on its own. So subproduct field is the key to this. If you get nothing else out of today's presentation, subproduct field is the key to this pricing. I'm going to stop sharing, switch back over to our presentation. And pull that back up. On this. So let's talk about a few things to keep in mind, and then if we have any questions, we'll make sure that we answer those for you. Again, the delivery commitments are amount sensitive. You know, I say this tongue in cheek, but the 125 max, the max stands for maximum. That's the maximum loan amount that can be sold into that delivery commitment. So as you see here, $130,000 loan could not be sold into the 125 max DC. The system will not allow it. It will give you an error for that at the funding portion of it. So, you know, be sure to make sure that you don't run into that issue. As I said, it's a bottomless floor, however, so that the $125,000 loan could be sold into the 175 or the 225 and have no issue. You just don't get the max price available to you. So essentially the 125 is from 0 to $125,000 loan. The 175 is from 0 to $175,000, and the 225 the same, 0 to 225. It's just that each of those, as we saw when we looked at the rate sheets, would provide a lesser price than does its lower counterpart. We stress this a lot because if you do lock it in correctly, it can't be changed. The system will not allow you to just move it to a different subproduct. It is its own delivery commitment, just like any other commitment. So if you do lock it in correctly and you try to use it and cannot, the only option is then to either substitute out, or the only two options, are to substitute a different loan for a lower loan size into it, or you have to pair it off and lock it in under the appropriate dollar amount. So that is very, very important to make sure that you manage that and handle that correctly. If you are sitting on the edge, right? And this isn't as big of an issue right now as we deal with purchase transactions, as those dollar amounts and everything stay pretty consistent. But even still, if you're sitting on a loan, and everybody's comfort level is different, so take this with a grain of salt. But you're sitting alone at $123,000, but there's wiggle room for costs that maybe or haven't yet finalized. You may be better off locking at $175 and hedging your bet. Yeah, you may lose 20 basis points of premium, but you're still getting better than you would have, 30 days ago. And you're also ensuring that you don't have to worry about the pair-off fee. We had a question previously, not here today, but it may be a question that you have. As you are aware, the bank's delivery commitments do have a tolerance level on the loan amount, 5% up or down. That 5% up or down still exists. However, it does not carry over to the 125 or to the max DCs, meaning that if you have a loan at $123,000, you can use your tolerance level up and down, but you're still capped at $125,000 in this DC. So in that, if you locked it under a $125,000 delivery commitment, you would have your 5% down, of course, but you'd only have the up to the 125. You could not exceed the $125 amount and still use that delivery commitment, even if the original amount locked was below it. So keep that in mind. When you fund it, it is all going to be based upon that dollar amount. We do have 2 different financial intelligence articles that we have put out there, both explaining a lot of what we talked about here already this morning, as well as walking through the step-by-step process of the delivery, including that sub-product field conversation. With that, let us open it up for any questions that you might have on the usage, any questions that you have on the process, anything that we can answer for you at this point as it pertains to the low loan balance pricing process. Aaron is informing me we haven't received any questions yet. Now would be a great time if you've got anything at all. We'd be happy to answer it for you. Very good. Well, you know, as I said at the beginning, we're very excited to roll this out. And we're very excited to give this information to you so that you can see where that potential benefit is. As we reach now into the selling time of the year, obviously for most of our members, it's the spring and into the summer. There's an opportunity here to take advantage of the loans that fall below these loan sizes and deliver in those loans to the program while still being able to offer the best rate you possibly can to your borrowers and generate an income stream that makes sense for your institution. Trying to make sure there's nothing else that I wanted to ensure that you received with this today. The key things, again, sub-products. Sub-product field is the key. If you run into any questions, I said, as you move forward, reach out to Aaron, reach out to myself. Don't lock it in and then ask your question. You know, reach out to us, say, hey, I'm working on this. What do you think? We've had people already do that, and it you know, measure twice, cut once. You know, the old adage. Let's save ourselves some headache and some heartburn down the road, but take advantage of this particular option as much as you can. Always available, myself and Aaron, to answer any questions. We're happy to assist. Hopefully, as we move forward, we will add additional tiers to this process. Obviously, we'll notify everyone as that does occur. As we, the program, get more comfortable with this price and spread and want to continue to grow that particular option, we will let you know when any of the other tiers are again activated. Again, Aaron tells me we still have no questions. Hopefully that means that all of them were answered here for you today. Or if you're shy, just reach out after the fact. You see both of our email addresses up there. We're more than happy to answer them. With that, I greatly appreciate your time today. We appreciate everything you do with the MPF program. We'll give you back about 15, 20 minutes of your time here on a Friday morning. So I hope everybody has a great weekend. And thank you again very much for joining us this morning.